Most first-time buyers get this wrong, and so did I. If you think that your property budget is just the purchase price, then you'll realize too late that you're paying too much. I bought my place on my own, no partner, no family money, which meant that there was no room for error. If I miscalculated, there was no one to fall back on. So I spent months researching, not just the purchase price, but the hidden costs, the monthly reality, and how much I could actually afford without stressing about money every single day. In this video, I'm breaking down my actual property budget so that buying a home didn't cost me my peace of mind. So let's get it on! So I define property budget in two ways: the number you say versus the number you live with, or what I like to term the public versus the private budget. Most first-time buyers like to plan carefully for the number they say, but they often underestimate the number they live with. That gap is exactly how people end up feeling stretched, stressed, or locked into a home that costs much more than they expected. In this video, I will show you how I define both numbers so that you can buy a home and sleep well in it at night. To determine your public budget is simple. Think of it like this. You might qualify for a huge loan, but if you do not have enough cash for the down payment, then that budget is fake. On the other hand, you might have a big pile of savings, but if you feel uncomfortable paying out on the loan every month, then that budget is also fake. Your real budget is the more conservative of the two. So here's the cheat code. Your public budget is simply the lower of what your maximum comfortable loan can afford or what your maximum comfortable down payment can support. You notice I keep using the word comfortable here. And that's because on paper, a budget can look fine, but real life doesn't stop after you buy a home. You'll continue to have ongoing costs, surprise expenses, and your lifestyle inevitably will get more expensive. So if your loan or down payment already feels tight on paper, it usually feels worse in real life. Therefore, emphasis on comfortable. Now that we have defined our public budget, let's go to the first part of the equation. How much is the maximum home loan you can comfortably pay off every month? Here's the approach I recommend. Instead of starting with what the bank allows, we're going to start with what we're comfortable with paying out every month. Now, these payments can be huge. For Singaporeans and PRs, you can use a mix of CPF OA and cash to service the mortgage repayments. First, find out how much CPF OA you receive each month. If you're employed, you can easily check how much CPF contributions are being paid into your account every month. From there, just multiply 60% to get the amount of payments that is going into the CPF ordinary account. And that will be the maximum amount that you are comfortable with withdrawing out of CPF every month. Next is cash outlay, and this is where most people get it wrong. A common mistake is estimating affordability of the home based on your current lifestyle. But once you own a home, your expenses change. So instead, do a future expense audit. Assume that you already own the home. Now, I want you to start with your non-negotiable expenses. So these include existing home loan and other debt repayments. If you have any annual payments, such as insurance premium and property tax payments, they should be amortized into monthly payments. Then we want to lay in the non-negotiable expenses, which are adjustable. This includes food and transport, subscriptions, expenses on any hobbies, as well as any ongoing savings goal that you have, such as a travel fund or emergency fund. These expenses should be realistic and not minimal, because we're budgeting to live a good life, not just to survive. Alright, now comes the simple math. Take your post-CPF monthly income and deduct the non-negotiable adjustable expenses. That gives you your maximum comfortable monthly installment in cash. This number, combined with your CPF OA, is the mortgage payment that you can realistically handle. Once you have that number, plug it into the CPF mortgage calculator, and I recommend testing a range of interest rates. You can start with the current rates, which is about 1.6%. You can also use 2.6% because that's the HDB home loan rate, and stress test up to 4.9%. That gives you a range from conservative to optimistic, and you can decide on the number based on your housing needs and risk appetite. So do note that there are actually legislations by MAS governing the size of the maximum home loan, and this will limit how high your maximum comfortable home loan can be. For ECs and HDBs, the mortgage servicing ratio or MSR caps the amount of monthly mortgage repayments at 30% of a borrower's monthly income. That means someone who makes $10,000 every month should only be paying a max of $3,000 a month in mortgage repayments, and that in turn caps the size of the home loan. For private properties, on the other hand, the MSR doesn't apply. Instead, the total debt servicing ratio, TSDR, caps the total monthly debt obligations, which includes housing, car loans, and credit card debt, at 55% of gross monthly income. So the same person who makes 10K a month with no other outstanding debt can pay up to 5.5K on the housing loan if they decide to buy private property, and therefore they will have a higher maximum home loan. Do note that the upper limit of 55% TSDR applies to everyone regardless of whether you buy HDB or buy private property. In any case, your maximum comfortable home loan should be lower than your maximum home loan unless you're a super high income individual with very low expenses. A tip here, if you want an accurate estimate of the maximum home loan that you can get, you can actually do an in-principle approval or IPA by requesting that from a bank. An IPA takes into account your credit score, any existing debts, and your job and monthly salary stability in order to give you the most accurate estimate of how much your home loan should be. So just know this, that your IPA number will be much larger than what you can comfortably afford, but at least it gives you the assurance that the banks are willing to lend you the money. Now that we've got the home loan figure, we can convert this into the implied property price. Since the home loan can pay for up to 75% of the purchase price, we'll just need to divide your maximum comfortable loan by 0.75 to get your purchase price. And this will be one part of your public budget. Now, when people think about affordability, they often think about the loan, but in reality, the upfront cost is the real bottleneck. So, what counts as upfront costs? Let's start with the basics. For both HDB and private property, the minimum down payment is 25% of the purchase price. But that's not the full story. On top of the down payment, there are additional fees that need to be paid upfront. These include valuation fees, buyer stamp duty, legal fees, additional buyer stamp duty, renovation costs, and cost over valuation. So my immediate question was, so how much funds do I need and when do I need to pay them? And for those of us who may have money sitting in asset classes like bonds, equities, and crypto, you need time to convert these assets into cash. So timing really matters here. First, let's understand the simplified purchase timeline. Upon agreeing on terms with the seller, you will sign an agreement called the option to purchase so that it reserves the property and the seller can sell to nobody but you. From that point, you typically have 2 weeks to exercise the option. During this period, you'll hire a lawyer, secure a home loan from a bank, and arrange payment of fees. I like to call this phase the post-OTP rush, because you'll only have 2 weeks to do all of this. If all this sounds foreign to you, check out this video that I have made. It helps to demystify the purchase process and lets you know on exactly what you need to do during this 2-week period. I've linked it in the description below, so do check it out. After the OTP is exercised, HDB sales completion usually takes about 8 weeks, while for private property, completion would take around 8 to 12 weeks. So by completion, the entire down payment must be paid. Now, when we look at this timeline, let's figure out how much do we need. Let's assume you choose to pay the minimum down payment of 25% of the purchase price. When you sign the OTP, 1% of the purchase price must be paid. This must be paid in cash only. And for me, I transferred this amount via PayNow directly to the seller. When you exercise the OTP, you'll also have to pay another 4%, also in cash only. At this point, you'll need to pay several other fees. You may pause the video now for all the estimates. Finally, at completion, 20% of the purchase price is paid. You can use both cash and CPF OA to pay for this. If your purchase price exceeds the property valuation, which is especially common for resale HDBs, you may need to pay cash over valuation or COV at the point of purchase. This must be paid fully in cash upfront as well. Now that you have understood the timeline, you're now ahead of 99% of homeowners because you know that you need enough funds in cash plus CPF to cover the down payment and hidden fees before you actually decide on a suitable budget. Now, one last cost to keep in mind: renovation. This often comes shortly after completion and it is very easy to underestimate. For me personally, because I have a stable job, a good credit score, and no existing debt, my property budget was more limited by the amount of down payment that I could fork out upfront rather than the maximum home loan that I can take. If you're like me, where the upfront cost is the biggest hurdle between you and your dream home, I've made another video where I review the exact strategies that I used to save up for my down payment. It won't be up yet when this video goes live, but if you don't want to miss it, you know what to do. So now let's bring it all together. The public budget is the lower of the maximum comfortable home loan divided by 0.75 or your comfortable down payment multiplied by 4. And the private budget is the public budget plus any upfront hidden costs plus any recurring homeowner costs that you'll need to incur for the rest of your homeowner life. So that's it. I hope this video takes you one step closer towards owning your dream home in Singapore. If your concerns on buying a property go beyond that of the purchase price and more about navigating this whole property journey, which may feel confusing and overwhelming to you, I've broken that down in another video and linked it here so that you can watch it next. I'll see you in the next one. Bye!